Going with the trend gives you a better chance of winning. But you have to watch out for reversals, because they can take away your profits. Additionally, deep retracements can stop you out, even if you were right about the overall direction. There's a common saying, the trend is your friend unless it ends. So, is there a simple and mechanical way to find the real market direction and read the reversal signals the market is giving? The answer is yes, and in today's video, I'll show you how to do that step by step. So guys, if that's something you're interested in, please smash the like button to help us create more videos and subscribe if you're new. The market always moves in the form of impulsive and corrective moves due to the behavior of market participants. Impulsive moves are characterized by the same colored candles, large bodies, and a great pushed distance. Corrections or pullbacks, on the other hand, are characterized by mixed color candles, sideways wicks, and a smaller pushed distance. In an ideal trending scenario, the market forms higher highs and higher lows respecting the swing lows. Each time the price breaks above a structure level, it signals trend continuation, and a demand level automatically forms. Conversely, when it breaks below a structure, it signals a possible trend reversal. But here comes the confusion most traders face. Does this move qualify as a pullback, or should we take the whole movement as a single leg? In other words, is this a swing low, or is it just valueless internal volatility that we should neglect? Because if this is a swing low, then breaking below it signals a reversal. But most of the time, price just continues moving upward after breakouts. So let me explain the most mechanical method to identify valid pullbacks and filter out internal moves and noise. This technique uses Fibonacci retracement levels to pinpoint the depth of correction. Here's how it works. When the market makes an impulsive move, we draw the Fibonacci retracement from the start of the recent impulse to the end. For a pullback to be considered valid, it must retrace at least to the 38.2% level. If the price doesn't reach this level and continues higher, it's often just internal volatility, a weak reaction with no real correction behind it. These shallow moves are unreliable and can lead to false signals. By waiting for a pullback to hit the 38.2% level or deeper, we ensure that we're only reacting to meaningful corrections, not just market noise. So in this case, it is considered a single leg, and a reversal only occurs if the market breaks below this swing low. Let's recap this in a bearish scenario. To identify a valid pullback, the retracement must reach at least the 38.2% Fibonacci level of the previous bearish leg. If the correction doesn't meet this minimum level, we consider it insignificant noise, not a true pullback. These shallow moves often lack real selling interest and can mislead traders into expecting a reversal too early. For example, let's find out if this move is a valid pullback or just noise in the price movement. If we apply the Fibonacci retracement tool from the start of the impulsive move to its end, we'll see that it has reached the 38.2% level. This confirms that the move qualifies as a valid pullback. It shows that the market has paused long enough for some profit-taking or counter-trend interest, which adds structure to the chart. From this point, if the price resumes in the direction of the original trend, we have a break of the market structure and can look for continuation setups with more confidence. On the other hand, if the retracement had only reached, say, the 23.6% level or even less, we'd consider it internal noise, and this would be treated as a single price-moving leg. In this case, there would be no break of structure and no valid swing high. Now that we know how to identify impulse and pullback, let's talk about market direction. When we see 1, 2, 3 moves breaking above the previous structure, that tells us we're in a trend. If the price then forms another pullback and impulse, we have trend continuation. Now here comes a very important point. We mark the lowest point of the pullback as our swing low, but only after a break of structure has happened. This means that during a correction, the price might create many lows, but those are not swing lows. Breaking below these minor lows does not mean the trend is reversing. The real swing low is confirmed only after the market structure is broken. Then the lowest point of correction becomes our swing low. and breaking below it signals a possible reversal. Let's look at a bearish price action example to apply this method and clear up any doubts. So here we have a bearish market structure. At first look, it might seem choppy with no clear direction, but we're going to apply our method and find out what the market is really doing as price action forms. Also, keep this in mind. If you're trading a trend continuation setup, it's best to focus on charts where the direction is clear. Avoid choppy, unclear markets. Now let's start from the beginning. Here we have 1, 2, 3 moves breaking below the recent structure. So we're in a downtrend. Here is our low, high, and lower low. If price breaks below the recent structure again, the trend continues, and the correction should happen within this range. Let's see what happens next. The market makes a small pullback and continues downward. So after this breakout, we can mark the recent swing high and swing low. Breaking below the swing low means trend continuation, and breaking above the swing high means a potential reversal. So again, the correction happens inside this range. But wait, is this a valid correction or just noise in the price chart? To answer that, we use the retracement tool to measure the depth of the pullback. If we apply the retracement tool from the start to the end of the impulse, we'll see that this pullback does not reach the 38.2% level. So this is not a valid correction. We should treat the whole movement as one single leg. Let's keep going. We now get another break of the market structure to the downside. So we mark a new swing high and low. We're still in a downtrend as long as the price stays below this swing high. Next, price taps into this structure level but fails to break it. These long wicks show that sellers pushed the price through the swing low, but it quickly returned back inside the range. This shows some bullish strength. But still, we are in a downtrend as long as the price stays below that swing high. Price tests the level again, and finally, we have a breakout above the swing high. This signals a potential reversal to the upside, and possibly forms an uptrend in the following moves. But to confirm the uptrend, we need to see 1, 2, 3 moves to the upside. Now let's see what happens next. Price suddenly drops, breaking below the structure again. Now we have a confusion. The market is breaking both up and down structures. This means there's no clear direction. When this happens, we need to wait and see which side takes control, supply or demand. Then we can look for clear impulses and corrections again. Here's another key point. Always trade when you know what the market is doing. You don't have to trade every day. Waiting for high-quality trades is a skill you must develop if you want to be consistent. Now let's continue. Price forms 1, 2, 3 moves breaking above the market structure. So now we are in an uptrend. Then we get one more impulse and correction. So yes, this is a trend continuation. As long as we stay above the swing low, we're still in an uptrend. And if price breaks above the previous level, it means the trend continues. So if we wanted to mark the market direction in this example, it would look like this. The red areas show when we had a bearish trend. The green area shows when we had an uptrend, and the gray areas are neutral, with no clear direction. Now that we've talked about the breakout, it's time to see what qualifies as a valid break. Now we have already mentioned several times that a break of structure signals trend continuation. Additionally, it allows us to pinpoint the recent swings. But what qualifies as a valid break of structure? A break of structure is only valid if there is a candle that clearly breaks and closes through the structure level. Although a wick above this high shows that buyers were able to extend the boundaries and push the price higher, it also shows an immediate rejection back inside the range. This often resembles a liquidity grab, where stop losses are triggered for traders who went short due to the previous rejection. If we get another break with a full-bodied candle, it signals a valid breakout. At this point, we can identify the origin of this move that caused this breakout as our swing low. As long as the price stays above this level, we remain bullish and focus on buying positions. But what happens if the price breaks and closes below this high-quality demand zone? This would indicate that buyers have failed to hold the level, and sellers have taken control. It signals that the uptrend is over and a potential reversal is underway. So, when price breaks through a high-quality level like this, we can confidently say that the market structure has shifted and the momentum is now favoring the sellers. This condition is known as a change of character, signaling a shift in market sentiment. The change of character is valid except in two common scenarios. Sometimes the market structure conditions make these changes invalid. Let's break this down step by step. Right here, we have a major swing low that triggered this breakout. A break below this level might seem like a valid change in character. However, if you look at the left-hand side, you'll notice something important. This level aligns with a significant area of liquidity. Here's the deal. Many traders previously opened long positions at this level, placing their stop losses just below it. What does this mean? A massive pool of liquidity is sitting beneath that level, waiting to be tapped. Now, smart money knows this. To hunt these stop losses, they often push the price lower, sweeping the liquidity before driving it back up in the same bullish direction. Here's the key takeaway. When a major swing low sits in a liquidity hotspot, breaking through it is often just a liquidity grab, not necessarily a signal of a market reversal. In this context, we can't classify this break as a valid change in character. If the price re-enters the range after the liquidity sweep, it creates an excellent opportunity for a long position. Why? Because the overall trend remains bullish, the sell-side liquidity has been engaged, and the next target is the buy-side liquidity. As smart money traders, our goal is to enter after the stop losses are taken out when the real move begins. Now, that's just one piece of the puzzle. Let's talk about another concept that can also invalidate a change of character: the mitigation of fair value gaps. As a smart money trader, identifying FVGs should be one of the first steps you take when analyzing a chart, because these zones often act as magnets for price. In most cases, before continuing its trend, the market pulls back to fill these gaps. This is why FVGs are critical zones to watch. They're most effective on intraday time frames such as the 4-hour, 1-hour, or even smaller time frames. Now here's where it gets interesting. Let's go back to the earlier example. Look closely at the left-hand side, and you'll spot an unmitigated fair value gap sitting just below the major swing low. In scenarios like this, price often retraces to the FVG zone to fill the gap. This pullback doesn't indicate a true reversal. It's simply the market rebalancing itself. The bottom line? Always check the left-hand side of the chart for unfilled FVGs. This helps you distinguish between a move that's just filling a gap and one that reflects a real shift in market sentiment. By doing this, you can avoid false signals and stay aligned with the bigger picture. Now that we understand how to identify market direction using breakouts and changes, let's take it a step further and see how the system of market sentiment actually works. The system operates based on mitigations. When price mitigates a demand level, demand takes control over supply. Conversely, when price mitigates a supply zone, supply takes control over demand. I know it sounds so strange, but it all will make sense in a minute. Imagine the market is in an uptrend, forming a series of higher highs and higher lows. Each time price breaks structure to the upside with fair value gaps, a strong demand zone is created. These demand zones remain unmitigated until price revisits them, offering ideal opportunities to trade with the dominant trend. However, if the price breaks below a strong demand area, it forms a change of character. This signals two key things. First, supply has taken control over demand, and second, a new valid supply area has been established. From there, the price continues moving downward, forming new supply zones until it reaches the next unmitigated demand area. At this point, a battle between supply and demand occurs. Sometimes this results in consolidation and a ranging market between these two zones. A break above or below the range will determine which side gains control. Now, a quick tip for the end of the video. Don't chase the market. Let the market come to you. Having patience, trusting your analysis, and waiting for mitigations can be the difference between a winning trade and a losing one. So guys, I hope this video provided value to you. If it did, please go ahead and smash the like button to show your support. And if you're new here, consider subscribing to our channel. See you in the next episode.